Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Jeremiah Lane, co-head of Global Leverage Credit at KKR. He's going to unpack the key opportunities and risks in global credit markets today. Welcome, Jeremiah. Thanks for joining us.
Thanks for having me.
So we've seen a lot of market activity since April. How are tariffs and global trade tensions rippling through the high yield and leverage loan market?
So initially we saw the markets sell off significantly. Since then, the market's really staged a pretty strong recovery. We've seen double Bs very quickly get reaccepted by the market. Single Bs have now been really reaccepted by the market. In the loan market, as an example, we're seeing repricings of assets rated double B and single B in a significant way right now. Triple Cs have been much more slowly reaccepted by the market. And I think some of that is that some of those companies people are concerned about impacts from tariffs. Some of them are just more highly levered, and to the extent that tariffs ultimately cause more economic disruption, they'll be more impacted. In a lot of ways, the recovery that we're seeing coming out of the Liberation Day announcements is a mini version of the recovery that we saw from the COVID disruption 2020 and 2021. I think there's a similar thing happening right now, just on a much shorter time period. Maybe it took 18 or 24 months coming out of COVID. It's taken 3 months, and maybe it'll take another 3 months to see the recovery of the balance of the market.
So in light of persistent inflation and potential tariff-related stress, which sectors are you watching most closely from a credit risk perspective?
Sure. I think the interesting thing with tariffs specifically, it's really the devil's in the details. It's really an issue of credit by credit assessment of how companies can raise price and reposition them, their supply chain to respond to tariffs. So the tariff response hasn't been a broad-based sector response. It's been very name specific. And just to bring it to life a little bit, we've seen, as an example, we saw one company that was a retailer. Initially, the price of its loans fell significantly. I think pretty quickly the market came to the conclusion that its supply chain wasn't different than competitors' supply chains. And so everybody was going to be dealing with the same tariff consideration. And as a result, to the extent that price increases had to be taken or supply chains had to be repositioned, this company that I have in mind wouldn't be worse off or better off. And quite quickly then, the market reaccepted it. Thinking about specific sectors that have been tough, it's probably a little bit away from specifically tariffs. We've been very cautious around building products for the last year and a half or so. It feels to us like that was a very good decision to be more cautious about that sector. Those companies saw sort of cycle highs in 21, 22, and now they're having to give back both volume and price. It's really squeezing profitability. I'd also say that we're reasonably cautious around some parts of the healthcare ecosystem. There's a lot of change happening in healthcare right now. New administration is trying to roll back some of the expansion of Medicaid. Medicaid is the U.S. program for lower income Americans. And there's just a lot of pressure on the amount of money that has been spent for medical care over the last handful of years. And I think that it just makes us a little bit more cautious. We think you can still invest there, but you need to be alert to changes in reimbursement from the government and changes in how that market is performing.
So where are you currently finding the most compelling opportunities in global credit markets, and how do the US and Europe compare?
Sure. I think at an asset allocation level, so when we compare the U.S. loan market to the U.S. high yield market to the European markets to CLO tranches, we see a lot of that as roughly fair value. U.S. loans versus U.S. high yield, we don't see one of them as significantly cheap to the other. U.S. loans at an index level have about 100 basis points more spread available than U.S. high yield, but U.S. loans have also had more problem credits. There are more sponsor-backed companies. It's a little bit of a lower quality market, and there's been more liability management activity in the loan market. And so all of that tells us that loans versus high yield, we think fair value between the two. We have liked Europe. Europe to us has tended to offer a bit more quality. So in the high yield, European high yield is about 15 points more in double Bs than the US. So it's a higher quality mix. And depending on when you're entering, offers consistent spreads, maybe a little bit more spread, and has over time been a little bit less volatile. So Europe's been attractive. And then CLO tranches, we have liked CLO tranches over the last period of time. They've really rallied. And so, I think they look, pretty fully valued to us right now.
Okay, so we've seen a sharp rally in recent months. How are you approaching income generation in this environment, and what role do multi-asset credit strategies play in building a diversified portfolio?
Sure. I think that we're seeing the market accept some credits that I would say, should price at a higher level than the market thinks they should price. And so, that tells us that now's a moment to be cautious. It feels to me like there's a very healthy demand for loans, bonds, credit in general. And largely because of the disruption associated with Liberation Day, there's been this really prolonged period of low deal activity. And so when you think back to the start of the year, a lot of people were optimistic that there would be a real boom in activity in 2025. It hasn't materialized because of that disruption. And so with that supply-demand imbalance, a lot of demand, not enough supply, we've seen spreads go tighter, and we've seen some lower quality businesses able to access the market at what I would consider to be very tight spreads. And so in that context, we want to be cautious. We want to try to stay invested in the highest quality businesses so that when the tide goes out, and the tide always goes out at some point, when the tide goes out, we're in businesses that have really resilient cash flow, that we have a lot of confidence in the durability of their cash flow and downside protection. And then, in that environment where the tide goes out, we'll be able to use our investments there to play some offense, sell them near par, buy something that's maybe traded off, offers a bit more return. Our belief is that, while these markets largely move with each other, and high yield tends to tighten alongside the loan market, US and Europe do tend to tighten with each other. There are opportunities, there are moments in time where there's significant relative value between the different markets. And one of our most successful trades over the last couple of years was really aggressively moving into CLO tranches at the beginning of 2023 when they were very wide, and then moving back out of them when they tightened. And in doing that, we were able to significantly generate returns significantly beyond what would have been available if we just stayed in loans and bonds. And so that's the opportunity with MAC. The opportunity with MAC is on a short-term basis, you'll see these differences in price develop between the markets. And in a single structure, a single mandate where you have the flexibility to move back and forth between the different asset classes, we can capture that. And for many of our clients, if they have to make a decision to move back and forth, it happens much more slowly. And so it's much more difficult for them to capture that inefficiency, that difference in price. And so that's what we're trying to achieve with our MAC strategies.
So how are you approaching the trade-off between fixed and floating rate securities in today's environment?
Sure. So I mentioned that we don't see a significant value differential between where loans are and high yield is today. And so, that really puts us back into more of an assessment of the credit quality of the individual companies that we're investing in. So we think of ourselves as specialists in diligencing and validating durability of cash flow and downside protection. And if there isn't a significant trade-off between loans and bonds, most of our mandates that are multi-asset in nature have a 50-50 benchmark, will be similar, 50-50, half loans, half bonds, will be similar exposed in our portfolios. And the name of the game in that environment to us is much more about about assessing the credit quality of the individual companies. In general, we seek to deliver return for our investors by identifying good businesses that will pay us consistently over time. We're not a high velocity trading shop. We're also not trying to take big swings at duration. So we will go a little bit off of the benchmark in terms of duration if we think the market is expecting maybe a few too many cuts or a few too many hikes. But we're going to stay pretty close to home in that part of our portfolio.
What's your outlook on short-dated loans and short-duration high yield, particularly in periods of volatility?
Sure. So we've really liked what has been available to us. I would say that short-duration high yield specifically has been really interesting. In the market today, we see a lot of securities that were issued from the end of 2020 to the beginning of 22 when rates were very, very low. They have extremely low headline coupons and maturities that are coming up in the next handful of years. And we think you can build a portfolio of those that on a headline yield to maturity basis offer a spread of about 150 basis points, but they're prone to having returns significantly above the headline yield to maturity that you buy in at, because most businesses will tend to do a refinancing substantially in advance of the stated maturity date. So if you're buying a bond at 90 that you expect to that the market is pricing as though it will be paid off at par in 3 years, but instead you get a par payoff in 1 year, you get that pulled to par over a much shorter period of time, it generates a much higher return. That's been a really interesting part of the market to us. We tend to access that market solely focused on double Bs and single Bs, so not pursuing triple Cs. We've seen very little default activity in the part of the market that we're focused on. And it's been, and securities that we buy have tended to get called pretty quickly, so it's constantly sort of turning back into cash at a pretty high velocity. And so all of that has meant that part of the market has a nice place in our portfolios, and we continue to think about how we could use it in a bigger way.
You just touched on defaults just before. My next question was going to be, are you seeing early signs of rising defaults or stress? And how are you navigating credit risk as spreads remain tight?
Yeah, I wouldn't say it's early signs. I would say that we for the past period of time, we've begun to see a lot more liability management activity from the sponsors. Some of that ultimately turns into a default. Some of it turns into a recapitalization of business, and they can successfully migrate their way out of it. But specifically in the loan market, which is very heavily sponsor-backed, we've been running at modestly elevated defaults over the last year, and I think that that's going to continue to bounce along. We see a lot of sponsor-backed deals from that period of very low rates, end of 20 to beginning of 22, where sponsors paid very full prices on a belief that businesses were going to continue to experience really strong growth and that they were going to continue to finance themselves at incredibly low rates. That hasn't happened. And so that vintage, I think is going to have a lot more default activity than the long-term average, and we're starting to see that vintage sort of get digested by the market, if you will. And I think that that's going to take another year or two before the dominant share of deals in the market were cut at more reasonable valuations, more conservative overall leverage profiles. We sort of get a resumption of a normal default rate, a lower amount of liability management exercises.
Loan markets have seen unique dynamics lately, especially around LMEs. How is that shaping distressed investing and overall loan market health?
I think there is a cohort of sponsors that the market is a lot more cautious around. A handful of sponsors have been substantially more aggressive in pursuing liability management exercises. There's a big range of how you can approach the market for liability management. There's one version of those transactions that really pits half of the lenders against the other half, 51% against 49%. There's another version of those transactions that is much more collaborative. Sponsors are putting in money, lenders are maybe extending some incremental capital. I think that the market has gotten very cautious on a handful of sponsors that have been more aggressive in how they've approached problems in their credit. And then I would also say that we've seen a handful of sponsors really act in the right way. And there are some sponsors that have put in money to stabilize businesses that were underperforming, sponsors that have come to lenders and say, this investment didn't work out for us, we just want to manage a seamless transition to lenders as the new owners of the business. And that's really valuable information for us to have about who we want to do business with in the years ahead. And so all that activity has also meant that if you're owned by one of those more aggressive sponsors, or if your capital structure looks like a liability management exercise may be needed, the market is very skittish.
What makes you most optimistic about markets today, and what potential catalysts like M&A are you watching closely?
Our two main strategies, which is a multi-asset strategy and a concentrated high conviction strategy, we've run those strategies since 2008. And if you think about the range of environments that we've seen over that 17-year period, we were emerging from the GFC. You had energy recession in 15-16, you had COVID, you had rate normalization, you had the tariff shock, you had a long period of low rates, you've now had a period of high rates, you've had Republican administrations, Democratic administrations. We really feel that we've demonstrated that we can deliver strong outcomes for investors across a really broad range of market environments, and I think that that gives us a lot of confidence that we're going to be able to do that for investors going forward. When I think about just do I think that the stock market's going to go up, or do I think that spreads are going to rally significantly? I think that a lot of stuff looks pretty fully valued to us, and so again, that's a moment to be focused on investing in the best businesses, the businesses that will be resilient, when we come to a moment when things are not so fully valued. And that's our posture on how we're approaching these markets.
Okay, great. Thanks, Jeremiah, for sharing your insights with us today, and enjoy the rest of your time in Australia.
Absolutely. Thanks for having me.
If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel, where we release new content every week.